Hello, we are Alexander Herman, Alejandro Peñaranda, Carlota Fujua, Aina Planas, and me, Monica Pizarroman, and we are going to talk about the accounting cycle for service companies. In our presentation, you would see a brief introduction, then how to close entries, the trial balance, the complete accounting cycles, how to complete this accounting cycle for service firms, and then in another video, a brief example.
Accounting cycle or accounting process comprises a series of procedures regarding the collection, processing, and communication of financial information. The financial information is presented in the financial statements. However, before they can be prepared, the accountants need to gather information about business transactions and record them to come up with values to be presented in these reports. The journal book in the ledger book. 4. Prepare the unadjusted trial balance. 5. Journalize the adjusting entries and post the entries in the ledger accounts. 6. Prepare the adjusted trial balance. 7. Journalize the closing entries and post the entries in the ledger accounts. And finally, we are ready to prepare the financial statements. To close an account means to leave the account with a zero balance. A common practice is to close the account once a year at the end of the financial year, just before preparing the financial statements of a corporation. First, temporary accounts are closed, and after that, the closing of permanent accounts takes place. Revenue and expense accounts are called temporary accounts. At the end of that accounting period, their balance is transferred into the net equity account, profit loss for the period, also called net income. The next step is to record an entry for closing the permanent ones. Asset, liability, and net equity accounts opened during the financial year. At the end of the period, we will close all of them, including the account profit loss for the period, also called net income, which is opened in the process of closing the temporary accounts. Permanent accounts are reopened at the beginning of the next year. A greater amount of revenues than expenses means that the company made profits, whereas a lower amount of revenues than expenses means that the company made losses. Revenue accounts have credit balances. Therefore, closing a revenue account means transferring its credit balance to the profit loss for the period account. This transfer is accomplished by a journal entry debiting the revenue account in an amount equal to its credit balance, with an offsetting credit to the profit loss for the period account. The debit portion of this closing entry returns the balance of the revenue account to zero, and the credit portion transfers the former balance of the revenue account to the profit loss for the period account. Expense accounts have debit balances. Closing an expense account means transferring its debit balance to the profit loss for the period account by crediting the expense account and debiting the profit loss for the period account. As assets have debit balances and liability and equity accounts have credit balances, the entry to close these accounts requires debiting the accounts with credit balances, liability and net equity accounts, and crediting the accounts with debit balances, asset accounts. Here we can find a not compulsory but very useful way to organize the ledger book. If we divided the paper in two halves, leaving two columns, one on the left side and the other one on the right side, we would put the debit balances on the left side and the credit ones on the right side. Then, if we divided the paper once more in two halves, but this time leaving top and bottom sides, we would put the temporary accounts on the bottom part and the permanent ones on the upper side. This way, we should find the revenues on the bottom right side, the one that has the number 1, then the expenses on the bottom left side, zone 2, the assets on the upper left side, number 3, and finally the liabilities and equity on the upper right side, zone number 4.
Hi, my name is Alejandro Peñaranda, and I'm going to talk about the trial balance. The trial balance is a list of the names and balances of all the accounts that appear in the ledger. It contains both the balance sheet and the income statement accounts, so we can find the assets, liabilities, and equity, but also the revenues and the expenses. The debit balances are listed in the left-hand column and the credit balances in the right-hand column. The totals of the two columns should agree. So therefore, the trial balance proves the equality of the debit and credit entries in the company's accounting system. The periodicity is any time but is always prepared before closing the accounts and is required to be prepared quarterly by the Spanish PGCE. In the trial balance, the sum of all debit balances should equal the sum of all credit balances. This can make us think that the trial balance is the same as balance sheet, but this is not the case. We have to be careful because trial balance is not the same as balance sheet. In the chart, you can observe the differences between both of them, like for example in the content, in which in the balance sheet reflects the wealth of the company, and the trial balance reflects all open accounts and their balances. Or in the elements, like in the balance sheet, where we only find assets, liability, and equity. And in the trial balance, we can find those three plus expenses and revenues.
The completing accounting cycle is so much easier for services firms that have no inventory than in manufacturing firms. All transactions have to be recorded, either in the general journal or in the general ledger transactions, depending on the invoices or documents issued or received. Once all the accounting events have been recorded, either in the journal or the ledger, at a specific time period, the closing procedure comes next. First of all expenses and revenues are closed by using the T account, also called the net income. This is done in order to prepare the income statement. Afterwards, all assets, liabilities, equity, and accounts should be closed. This is done in order to prepare the balance sheet.
And now, just to sum up, I will resume the complete accounting cycle process. First of all, we have to record the opening entry, which is the balance sheet of the last year. Then record the daily transactions, every daily transaction. After this, we will adjust the entries for then closing temporary accounts. The last step is close the permanent accounts, so we are able to prepare the balance sheet and we are also ready to prepare the income statements with the closing of temporary accounts.